Something broke in the global financial system this week, something fundamental. And if you don't understand what happened between Wednesday morning and right now, Saturday, January 31st, 2026, you're about to lose money. Potentially a lot of it. Because what we just witnessed wasn't a normal market correction, wasn't profit-taking, wasn't even a crash in the traditional sense. It was a signal, a warning, the first visible crack in a pattern that's repeated itself across every major empire in recorded history. And once this pattern starts, it never stops. It only accelerates. I am Ken Au. Welcome to the Vault. Today, we dissect the $7 trillion erasure that nobody's connecting. And by the end, you'll see the four-stage pattern that destroyed Rome, Weimar, and Britain, and why we just entered stage 3. Let me give you the numbers first, then I'll show you why they matter more than anything you'll hear on financial television this week. Microsoft lost $357 billion in market value on Thursday, in one day. That's the size of Netflix's entire market cap. Gone. But that wasn't the story. Gold hit $5,680 per ounce on Wednesday, highest in human history. Then it crashed 12% in 18 hours. Silver plunged double digits. Lost decades of gains in under an hour. The dollar fell 3% against major currencies in 2 days. For a reserve currency, that's not a blip. That's an earthquake. And here's what nobody's connecting. On January 28th, the Federal Reserve paused all rate cuts. Cited persistent inflation. Political pressure from the Trump administration to cut rates anyway mounted. Then 24 hours later, European financial institutions started publicly questioning whether they should hold U.S. Treasuries, not quietly, publicly. China reduced Treasury holdings by $120 billion in January, largest single-month decline ever recorded. Now here's the part that should terrify you. The national debt of the United States reached $38.43 trillion on January 7th. That's $225 trillion higher than 1 year ago, which means we're borrowing $8 billion per day, every single day, including today. Interest on that debt hit $1.2 trillion in fiscal year 2025. We now pay more in interest than we spend on Medicare, more than we spend on national defense. Let that sink in. We're borrowing money to pay the interest on the money we already borrowed. And the pattern says this is stage 3, the crisis phase, the moment when the math catches up with the delusion. And every time this has happened before, without exception, stage 4 follows. The collapse, the reset. The transfer of wealth from those who don't see it coming to those who do. This isn't theory. This isn't speculation. This is historical record. Documented. Verifiable. There's a sequence. A pattern. 4 stages that every dominant empire moves through when they control the global reserve currency. Stage 1 is trust. Real trust earned through actual productivity. Military dominance. Sound money. The currency works because it represents genuine value. Everyone wants it. Everyone needs it. Trade flows through it. This stage can last centuries. Stage 2 is where the seduction begins. The empire realizes something dangerous. They control the money everyone uses, so they start creating more of it, not to produce more value, just to fund things they can't afford. Wars, social programs, political promises. The gap between what they collect in taxes and what they spend becomes permanent, so they fill it with currency creation, debasement, inflation. And here's the trick. Because they control the reserve currency, they export the consequences. Other nations absorb the excess money supply. The inflation gets delayed, pushed into the future. Stage 2 feels like prosperity. Feels like winning. It's actually the beginning of the end. Stage 3 is the awakening. The math becomes impossible to ignore. The debt can't be paid. Not difficult to pay, mathematically impossible. The currency starts losing purchasing power, despite interventions. Foreign nations start questioning whether they want to hold reserves in a currency being systematically destroyed. Confidence cracks, not all at once, in waves, a bank here, a central bank statement there. Then suddenly, violently, usually triggered by something that seems unrelated, a sovereign debt announcement, a geopolitical event, a market shock that reveals the fragility underneath. Stage 4 is the reset. The system breaks. The currency either hyperinflates or gets replaced entirely. Reserve status shifts to a new power or new system. Wealth transfers from those holding old denominator assets to those positioned in the new reality. This stage is brutal, fast, irreversible. Now let me show you this pattern in action. 3 times, 3 empires, same sequence, same outcome. Then we'll apply it to what just happened this week, and you'll see exactly where we are. Ancient Rome, 2nd century AD. The denarius was the dollar of the ancient world. Every trade route denominated in Roman silver. The coin contained 95% to 98% pure silver under Augustus. Trust was absolute because the value was real. For 2 centuries, the system worked. That's stage 1. Real money, real trust. Then came military expansion, Germanic tribes, Persians. The army grew. Soldiers demanded higher pay, Tax revenue couldn't keep up, so they made a choice. They started debasing the denarius. Nero reduced silver content to 90% in 64 AD. By Marcus Aurelius, it dropped to 75%. Caracalla cut it to 50%. The government was creating money by destroying its value. And for decades it worked. Soldiers got paid. Citizens got bread in circuses. Stage 2 looked like strength. Then the crisis of the 3rd century arrived, 235 to 284 AD. The silver content plummeted. By 269, the coin contained 2% silver, from 98% to 2% in 200 years. Prices exploded. A measure of wheat that cost 1 denarius in 200 AD cost over 200 by 270. Foreign territories stopped accepting Roman currency. The military couldn't be paid. 26 emperors in 50 years, most assassinated. That's stage 3, the awakening to mathematical reality. Stage 4 came suddenly. The denarius disappeared from circulation. Diocletian tried reforms, price controls, new coins. Nothing worked. By the 4th century, the Western Roman Empire abandoned the currency entirely, moved to taxation in goods instead of coins. The economy became feudal. Wealth held in denarii evaporated. Wealth held in land and tangible assets survived. The pattern completed. Let's verify it with a second example. Different time, different continent, same pattern. Weimar Germany, 1920. After World War I, Germany faced catastrophic reparations. 32 billion gold marks. The government couldn't pay through taxation, so they printed. The Reichsbank's presses ran continuously. Classic stage 2 thinking. In 1921, the exchange rate was 60 marks to $1. By January 1922, 191 marks. Then stage 3 arrived with violence. July 1922, 493 marks to the dollar. November 1922, 7,000 marks. August 1923, 1 million marks. November 1923, 4.2 trillion marks to the dollar. In 18 months, the currency became worthless. Workers demanded payment twice daily because money lost half its value by afternoon. Wheelbarrows of cash to buy bread. The middle class was annihilated, but wealth didn't disappear. It transferred. Those who owned land saw property values skyrocket. Those who owned foreign currency multiplied purchasing power. Currency collapsed. Real assets preserved wealth. That's stage 4. One more example to prove this isn't ancient history or a German anomaly. This happened to the world's superpower within living memory, the British Empire, 1815 to 1971. For over a century, the pound sterling was the global reserve currency. Sterling was backed by gold. That's stage 1. Then came 2 world wars, massive military spending, expanding social welfare. Government spending exploded while the industrial base declined. But they kept spending. They were Britain, the empire. Classic stage 2. Stage 3 crystallized in September 1949. Britain was forced to devalue the pound by 30% overnight. The market stopped believing. By 1967, another devaluation, 14%. The pound that had been worth $4.86 in 1939 was worth $2.40 by 1967. Stage 4 arrived in 1971. Nixon closed the gold window. The dollar replaced sterling as the global reserve. By the 1970s, Britain faced stagflation. Inflation above 20%. The IMF had to bail them out in 1976. An empire reduced to charity case. Wealth held in sterling lost 70% to 80% of purchasing power. Wealth moved to dollars, to gold, to American equities. The pattern completed again. 3 examples, 3 empires. Same 4 stages, same outcome. Rome, Weimar, Britain, setup, expansion, crisis, collapse. Every time. Now let's talk about what happened this week, about the United States, about the dollar, about where we are in this sequence, because every single characteristic of stage 3 is present right now, today. The United States established reserve currency status at Bretton Woods in 1944. We had half the world's gold, half the world's manufacturing, absolute military dominance. The dollar was backed by gold until 1971. But even after Nixon closed the gold window, trust remained. Oil traded in dollars, central banks held dollars, international debt denominated in dollars. Stage 1 lasted decades. Real dominance earned status. Stage 2 accelerated after 1971. Once gold backing disappeared, the temptation became irresistible. Federal debt in 1971 was $370 billion. Today, it's $38,043 trillion, a hundredfold increase in 54 years. We've added more debt in the last 15 years than in the previous 224 years of American history combined. Military spending exploded. Over 750 bases in 80 countries. Social Security expanded beyond sustainability. Medicare made promises no tax base could fund. The gap became structural, permanent, unbridgeable. So the Federal Reserve did what Rome did, what Weimar did. They created money. Quantitative easing, zero rates, direct market purchases, trillions out of thin air. And it worked for decades. Because we controlled the reserve currency, other nations absorbed our inflation. The consequences got exported. Stage 2 felt like American exceptionalism. It was actually currency debasement, but something changed, something fundamental, and it became visible this week. Let me walk you through January 28th to January 31st, 2026, day by day, so you can see Stage 3 crystallizing in real time. Wednesday, January 28th, the Federal Reserve holds its first policy meeting of the year. Markets expect rate cuts. The Fed has been signaling easing, inflation supposedly under control. Instead, they pause. No cuts, cite persistent inflation, stubborn labor market. And here's where it gets interesting. The Trump administration publicly pressures the Fed for rate cuts, launches investigation into Fed Chair Jerome Powell, questions Fed independence. Markets initially shrug this off, business as usual, political theater, but by close, yields spike. 10-year Treasuries jump to 4.3%. 30-year yields hit highest levels since September. Something shifts, barely perceptible, but real. Thursday, January 29th. This is when the crack becomes visible. Markets open in Asia down 6% to 9% across the board. Tokyo, Hong Kong, Singapore, all deep red. Because Asian markets understand something. If the Fed is losing independence, if political pressure is mounting, if inflation isn't actually controlled, then every dollar-denominated asset is at risk. European markets follow. A major financial institution announces it's unwinding $35 billion in U.S. Treasury positions, not because of default risk, because of confidence risk. They explicitly cite unsustainable debt trajectory and political dysfunction. This is unprecedented. A major European bank publicly questioning U.S. fiscal sustainability. Markets don't shrug this off, they panic. By the time U.S. markets open, futures are limit down. Circuit breakers trigger in pre-market trading. When the bell rings, it's bloodshed. Microsoft announces cloud growth concerns. Stock drops 10%. $357 billion in market cap gone. But that's just the headline. The real story is gold. The metal hits $5,680 per ounce. Highest price in human history. Up 30% for the month. This isn't speculation. This is flight to safety. Flight from currency to hard assets. Flight from faith to physics. Then the margin calls start. The CME Group raises margin requirements on precious metals. Leverage traders can't meet requirements. Forced liquidation begins. Silver plunges double digits in under an hour. Gold crashes 12% from its peak. But here's what's critical. This wasn't fundamentals changing. This was leverage unwinding. The underlying driver, the loss of confidence in currency, that didn't change. It intensified. Friday, January 30th. The liquidation spreads. Crypto markets dump. Bitcoin falls below $80,000. Ethereum under $3,000. Why? Because leverage traders are selling everything liquid to cover margin calls in precious metals. This is how contagion works. One market shock cascades into others. The correlation goes to 1. Everything falls together. Because the underlying issue isn't individual assets, it's the denominator. It's faith in the currency system itself. The dollar falls 3% in 48 hours. 3%, that's not normal volatility for a reserve currency. That's loss of confidence. Major currency traders start positioning for dollar weakness. Not tomorrow, now. Today, Saturday, January 31st. The markets are closed, but the damage is done. The signal is sent. Let me show you why this fits Stage 3 perfectly. Every single characteristic is present. Characteristic 1, sudden loss of confidence in sovereign debt. Check. European institution publicly questions U.S. Treasury holdings. China dumps $120 billion in 1 month. Japan considering reducing exposure. First major crack. Characteristic 2, currency instability despite intervention. The Fed issued emergency statements Wednesday and Thursday, promised stability, promised liquidity. The dollar still fell 3%. That's intervention failure. That's loss of control. Characteristic 3, foreign holders reducing reserve positions. Check. China's holdings reduction is the largest single-month drop on record. Japan's parliament debating reserve diversification. Saudi Arabia negotiating oil sales in yuan. The reserve status is eroding in real time. Characteristic 4, asset prices disconnecting from fundamentals. Check. Microsoft's business didn't change. Amazon's operations didn't collapse. Apple didn't lose technological advantage. But they all crashed double digits. Because this isn't about company value. It's about currency confidence. Characteristic 5, political paralysis preventing solution. Congress deadlocked on debt ceiling negotiations. Again, the White House and congressional leadership can't agree on basic fiscal framework. The political system is incapable of addressing structural problems. The debt keeps growing. The spending continues. The borrowing accelerates. Characteristic 6, mainstream narrative of temporary disruption. Check. Every financial news network called this a correction, a healthy pullback. A buying opportunity? Exactly what they said in 1929, exactly what they said in 2008. The denial is part of the pattern, but here's what's different this time. Here's why the transition to stage 4 could happen faster than any historical precedent. Institutional credibility is gone. In 1929, people still trusted institutions to fix it. Roosevelt, the New Deal. Faith remained. In 2008, people believed Bernanke and Paulson would stabilize the system. The institutions still had credibility. That's not true anymore. Public trust in the Federal Reserve is at multi-decade lows. Congress approval is single digits. Faith in the dollar as a stable store of value is openly questioned, not just by foreign governments, by American citizens. 23% of Americans now own cryptocurrency specifically as a hedge against dollar debasement. That was 2% 10 years ago. The institutional credibility that allowed previous Stage 3 moments to be papered over doesn't exist anymore, which means Stage 4 could arrive faster, more violently, with less warning than any historical example. So let's talk about what Stage 4 actually means. Stage 4 doesn't mean apocalypse, doesn't mean society collapses into Mad Max chaos. It means the financial system resets. The currency either hyperinflates or gets replaced. Reserve status shifts, and wealth transfers massively, permanently. In Rome, wealth held in debased denarii disappeared, but wealth held in land survived. Productive estates, real assets, in Weimar, cash holders were annihilated. But real estate owners prospered, business owners survived, foreign currency holders multiplied wealth. In Britain, sterling holders lost purchasing power for 50 years, but those who moved to dollars, to American equities, to hard assets built generational wealth. The pattern is consistent. Wealth doesn't disappear in transitions. It moves. From those who don't understand the pattern to those who do, from those holding old denominator assets to those positioned in the new reality. And here's what that means right now. If we're in Stage 3 and Stage 4 is coming, your financial positioning matters more than any decision you'll make in the next 5 years. Let me destroy the 3 most common objections. Objection 1, this time is different because we have technology. AI, innovation that Rome never had. Wrong. Germany in the 1920s had the most advanced industrial technology in the world. Didn't stop hyperinflation. Britain pioneered computing in the 1960s. Didn't stop decline. Japan had technological superiority in the 1980s. Didn't prevent stagnation. Technology creates productivity, but it doesn't eliminate the consequences of creating currency faster than value. The math always wins. Objection 2. The dollar is too big to fail. That's exactly what they said about the Roman denarius. Too integrated to fail. It failed. That's what they said about sterling. Too big to fail. It failed. Size doesn't prevent collapse. Size determines how catastrophic the collapse is when confidence breaks, and confidence shifts suddenly. We just watched it crack in 48 hours. Objection 3. American exceptionalism. We're the United States. We're not Rome. We're not Weimar. We're not Britain. Every empire thought they were exceptional, every single one. Rome thought they were eternal. Britain thought they ruled by divine right. They were all certain they had advantages that made them immune to historical patterns. They were all wrong. Exceptionalism is a story we tell ourselves. The math doesn't care about stories. So, what actually happens in Stage 4 transitions? What preserves wealth when currency systems reset? History provides clear answers. Hard assets with inherent scarcity. Gold has preserved purchasing power through every currency collapse in recorded history, not because gold is magical, because it can't be printed. Supply is limited by physics. Gold hit $5,680 this week for exactly this reason. Flight from currency to hard metal, productive real estate, agricultural land that grows food, income-producing properties, real assets that create value independent of currency. In Weimar, real estate owners became wealthy while cash savers were destroyed. Equity in productive businesses, not speculation. Productive companies that make things people need, energy, food, essential services. If you own a piece of a productive enterprise, the underlying business keeps producing value even as currency devalues. The key is productivity, real earnings, real value creation. This isn't about timing. You can't time Stage 4. Nobody can. What you can do is position so that when it happens, whether it's next month or next year or 3 years from now, you're not devastated. You might even benefit. What happened this week, January 28th to January 31st, 2026, wasn't the event. It was the signal, the warning. The visible crack in Stage 3 that shows us exactly where this is headed. Microsoft's $357 billion loss. Gold's historic spike and crash. The Fed's loss of control. Foreign institutions questioning U.S. debt. The dollar's fall. China's record Treasury sales. These aren't disconnected events. They're symptoms, manifestations. Proof points of a pattern that's played out across millennia. $7 trillion didn't just evaporate from markets this week through volatility and liquidation, it transferred. Some into hard assets, some into foreign currencies perceived as more stable, some into the accounts of those who understood what was happening and positioned accordingly. The next transfer will be bigger, much bigger, because Stage 4 resets entire systems. When the dollar loses reserve status or experiences significant devaluation, trillions will transfer. The largest wealth transfer in human history, from those holding old denominator assets to those positioned in the new reality. The pattern is here. The math is clear. The signals are visible. Go back through this. Verify every claim. Rome's denarius from 98% silver to 2%. Check it. Weimar's exchange rate from 191 marks per dollar to 4.2 trillion. Verify it. Britain's pound devaluation from $4.86 to $2.40. Research it. U.S. national debt at $38.43 trillion, growing $8 billion per day. Interest costs at $1.2 trillion. It's all documented, all verifiable, all real. Then ask yourself one question. If we're in Stage 3 and every historical example shows Stage 4 is inevitable, are you positioned for what's coming? Because ready or not, whether you believe it or not, the pattern doesn't wait. It doesn't pause. It doesn't reverse. It only accelerates. The transfer is coming. The pattern is unstoppable. The only question that matters is which side of that transfer you'll be on. Will you be holding paper promises denominated in a debasing currency? Or will you own real assets with inherent value? Will you trust institutions that have never successfully managed this transition? Or will you trust history, mathematics, and pattern recognition? The clock is ticking. The crack is visible. The signal has been sent. Stage 3 is here. Stage 4 is coming. And what you do next determines everything.